Hello and welcome. In this screencast, we'll take a look at how to decide if you want to purchase an asset through a direct purchase or through a lease payment. Now, if you are an individual, then if you're going to purchase an asset like maybe a costly computer or something, then you're not going to get any depreciation benefits from taxation. But if you're a business, if you're a firm, then you do get to write off the asset as depreciation over the next few years, and that depreciation can be shown as an expense in your for tax purposes, so that you pay lesser income tax. So there is that benefit from purchasing an asset outright, but then if you were to take a lease payment, if you were to take the lease payment route, then you can pay say a periodic lease, say annual lease or monthly lease, and it's like a rent that you pay to the actual owner, legal owner of the asset, and that can also be shown as an expense that will let you avoid paying tax. So which of these two alternatives is a better way to finance your asset? Okay, do you just purchase it directly or do you lease it out? So we'll explore that trade-off in this little example. So I'm just going to first enlarge the spreadsheet a little bit here by minimizing the toolbar. So let's say you have an asset whose price is $9,000. If you were to depreciate this asset, then let's assume you have a straight line depreciation over 3 years. So you would take the asset price, which is C2, divided by 3. So your annual depreciation is $3,000. Now, on the other hand, if you were to do a lease payment, let's assume that you have to pay $4,000 over 4 payments. Okay, so that's an assumption, and we'll play around with that a little bit. Now, let's also assume that you can borrow money from the bank at a 12% interest rate. So if you were to purchase the asset through a direct purchase, you can borrow the money, this $9,000 at 12%, or you can lease it at a $4,000 payment annually. Let's assume you're paying a tax of 30%. That is, your company's annual tax rate is 30%. So first thing we need to do is plot out the cash flows in each alternative. So if you were to purchase using an outright purchase, using say borrowed money, then you will initially pay out, let's say, a negative of $9,000. So that's your negative cash flow initially. In the first year, you will not get any depreciation tax shield. In the 0th year, as soon as you make your payment, you will not get a depreciation tax shield. But at the end of your first year, you will be entitled to a depreciation tax shield. Now, the tax shield is nothing but the tax that you did not pay because you were allowed to show depreciation on your books. So that is the depreciation amount times your tax rate. So this is the tax that you would have paid, but you did not pay because you were allowed to show depreciation. So I'm just going to I want to copy this to the next two cells. So what I'll do is I'll place my cursor in C6 and press my F4 button on my keyboard, and that'll put the dollar signs so that it'll do absolute copying. And here also I'll likewise press the F4 sign and press enter. And now if I drag my cursor to the right, it'll just copy this all the way here. Now, the total cash flows are therefore the sum of this plus this, and that is C11 plus C12. And I'm just going to copy this all the way here. So these are your cash flows. In the beginning, you pay out $9,000, and then you enjoy depreciation tax shield of $900 for the next 3 years. We take a look at your lease payment, which is $4,000, times, you will not pay the entire $4,000 because you're going to get a tax credit. Now, your lease payment of $4,000 is an expense in your income statement. So you will pay 70% of this amount because you're saving 30% of $4,000 that you would have otherwise paid as tax. So I'm just going to do a 1 minus 30%. So because that's what your real payments are. So even though you're paying out $4,000 to the lease company, you're saving 30% of tax on $4,000, which is $1,200, $1,200. So what you're really paying to the lease company is $2,800. And again, I'm just going to put the F4 sign here, F4 here, so that there'll be absolute cell referencing. I copy this all the way here. And the other wrinkle I need to do is I need to put a minus sign here, because you're really paying out this cash. So any cash that goes out of your pocket is a negative. Any cash that comes in is a positive. So that's our convention. So I'm just going to put a negative sign here. Now, what is the savings from adopting lease? The saving is really the lease payments minus your purchase related payments. And if you think of it, if you take a look at this example here, if you leased out, you would pay 2,800, but if you purchased, you would pay 9,000 at the very beginning. So the difference is really what you save by leasing. So your savings from leasing are C15 minus C13. If you press enter, and you can just copy this all the way to the right. Now you see that you have a positive savings of $6,200 if you were to lease, but you have negative savings of $3,700 if you were to lease going forward. So this is kind of like you're borrowing money from the bank and you're paying it out in the first, second, and at the end of the first, second, and third years. So since it looks like this, you can actually compute the internal rate of return for this cash flows. What is the implied interest rate for this set of cash flows? So the implied interest rate for this set of cash flows is 36%. So that means that if you were to lease, then as compared to purchase, it's as if you're borrowing money from a bank at 36% interest rate. What is your alternative cost? If you were to just say make a purchase, right? Then the alternative cost is basically your bank interest rate. Now the bank interest rate is 12%, but 12% is not your total interest rate because you're getting a tax credit on that. So any interest money that you pay, so if you, for every $100, if you were to pay out $12 as interest, so you save 30% of $12, which is $3.60. So you only pay the remaining amount. So your true cost is really your interest rate times 1 minus your tax rate. So the true cost is 8%. So if you were to borrow money from a bank at the rate at which they're offering, and if you were to make this purchase, then you're going to pay 8% interest. But if you were to lease it, you're going to pay 36% interest. So the better alternative is, in this case, to purchase it, and we can actually do a little if statement. If your lease savings IRR is greater than your interest rate from the bank, then you purchase, otherwise you lease. Okay, so in this case you have to purchase. Now obviously if you look at your annual lease payment, you're making 4 of these payments. Now 4 of them at $4,000 is $12,000, is $16,000, whereas your actual asset cost is $9,000. So just to kind of bring this more in line with 9,000, let's say you want to have a $2,500. So $2,500 times 4 is 10,000, whereas your cost of asset is 9,000. So what does it look like now? So now it looks like your IRR from lease savings is 5%, whereas the alternative cost is 8%. So in that case, you should lease. So hopefully that gives you some insight into how to construct your cash flows from purchasing an asset versus leasing an asset in the presence of tax shields that could apply to either depreciation or to lease expenses, and based on that, make an appropriate purchase decision. I hope you enjoyed this video. Thanks for watching.